quickly. As I mentioned, this webinar, we're gonna focus on transforming your cash flow starting in 30 days. And in this webinar, we will dive into a step-by-step guide for small business owners to improve your cash flow using a case study with real, obviously mocked up customer data. Okay. Oops. All right. Okay. So what you will learn as a takeaway today from this session is how to reduce your cash flow stress fast and build a plan for longer term success. Okay. Talking about cash flow, usually it's a very stressful term when I talk to founders and owners. Obviously, the founders are, they have a reason for being stressed. It is costing our founders more than what you might think initially. On the aggregated level, 82% of small businesses fail due to cash flow. And this is white published stats. You could check. Common struggles for founders. If they are short, if they're stressed about cash flow, they're late on payments, and they are worried about their income coming in. They feel like they have wasted expenses, but they don't even know where to start to trim their expense and have a better cash position. And on top of all those, we are experiencing quite a few headwinds in terms of being able to manage your cash flow in a healthier level. First and foremost is everyone, I'm sure tariff is on most owners' mind. And it is not just about the tariff itself. It is also about the ripple effect of the tariff. As you know, the tariff could be felt throughout the whole value chain or supply chain because it may drive higher costs of production. It may not be directly impact on your cost of production, but maybe on cost of production for your suppliers, for your vendors, and for partners. On the other hand, other ripple effect could include lower consumption level because people in general, they feel stressed about, they want to keep cash and therefore reduce their spending. Obviously, we do have a looming potential economic downturn. And because of the outlook, lenders may start squeezing the clients. And everyone, instead of spending money investing for growth, now we're all looking at, hey, versus growing the pie, can we look at the current pie we have and what's the best way to optimize the current pie, right? So those are headwinds everyone is experiencing right now. The key questions for the founders and owners are, I would say first, what if you could stop guessing and start doing something to improve your cash flow right away, right? I think I would call for action biased. Founders typically were action biased. What can we do immediately? What are the low-hanging fruits we could do to improve our cash flow right now? That's the step one, to start controlling your cash flow. And second, I would say how to plan more for the midterm to longer term to weather the potential rainy days that's coming and that's lurking, right? That's looming. Okay, so this webinar is about, I would say we will do a deep dive to try to answer both questions, how to improve your cash flow. Okay, all right. The overall structured approach of this webinar actually is part of a new release that my Pocket CFO is launching. Let's call it the Better Cash Management Guidebook. So what we are building is trying to build a personalized roadmap for our small business owners to achieve longer term financial confidence. Obviously, it cannot be built overnight. However, we are breaking this better cash flow goal into 3 key milestones. The first immediate milestone, I call it 30-day fat burning milestone. I use the analogy of, hey, when you try to get better health, when you try to be more lean. So this is very similar to go through I would say, a body health exercise. Within 30 days, we can, if you follow this methodology, follow this process, we can burn, I would say, material or significant fat. I call 30-day fat burning exercise. In this 30-day exercise, if you follow the process, we will help you to identify the opportunities that you could burn quickly, meaning the fastest opportunities to reduce expenses. On the other side, we would recommend opportunities that even if you burn it, it wouldn't affect your overall health, meaning it's least likely to impact your top line. So that will be in our 30-day fat burning opportunities guide. And then from there, I would say, if you follow this roadmap or guidebook, in 90 days, I call it level up the core. Meaning 90 days, we would want to work together with you to build up certain muscles, build up your core. So to make this lean body more sustainable. That includes surfacing opportunities that you can basically negotiate with your, I would say, transactional counterparties to reduce cost, or to even increase or shorten the cash collection cycle. The other opportunity we are going to dish out in the guidebook is opportunities we suggest to optimize your ROI optimization. And specifically, that may include optimization on your direct cost, meaning the cost that is directly associated with your sales. For example, typically that involves your sales and marketing cost. There could also be some one-time cash inflow opportunities that you could do just to, in the short term, to shore up your cash. Something like, I talked to Kiana about something like, hey, if you have a high inventory level, maybe you could do a flash sale just to reduce your inventory and return some cash back to your bank. So obviously, in the longer term, I would say 6 or 10 months, or even beyond, the goal is to go through more of a I would say, cash flow glow up transformation process. And in this process, in our structure guidebook, we will partner with you to recommend opportunities to do some of the more sophisticated and more time consuming, but more fundamentally change your cost structure things, such as restructure your unit economics. Unit economics, including like what is your production cost? What is your cost of goods sold as percentage of your average price? Those kind of structural, I would say, margin, like a gross margin, is harder to change on a short-term basis, but longer term, we could plan and have a systematic way to restructure it for the better of the business. And also opportunities to restructure, I would say, some key elements on your balance sheet, including restructure your debt. I think Kiana will talk in more detail something about restructure short-term debt to be more of a mid to long-term debt, restructure your way to leverage your credit. So anyways, this is our overall, I would say, approach of this guidebook. And with that being said, next, I know it's all just on paper, it's methodology, it's processes. Nothing is better than dive into a very specific case study with specific numbers and see how this process works. Sounds good? Let's go. Okay. Oops, sorry. let me open this file. So this is a you can think of this as a sample CPG company's P&L, profit and loss, as well as the balance sheet. And in this case study, between Kiana and me, we're going to dive into your P&L and balance sheet, and to follow the methodology of the 30-day fat burning, 90-day build up your core, and 180-day to restructure, transformation for glowing up, right? So I'm going to dive right into the income statement and go through a couple of examples of how we identify 30-day cash flow optimization opportunity, 90-day and 180-day. And Kiana is going to go through opportunities on your balance sheet. Sounds good? Okay, so let's go with that. So this is a sample customer's income statement. And I think to review this income statement, keeping in mind that our goal is to optimize cash flow. Optimize cash flow typically means, hey, how can I basically not minimize cash spending, but have I would say typically start with either reduce cash spending, increase my income in cash, right? Across both P&L and your balance sheet. And to do that, we kind of calculated three key vitals, and to give us a glimpse of your annual health check, to give us a glimpse of, hey, before we do this, how does this business look like on the P&L? So we calculated three key vitals here. Those are really the minimal essential vitals we look at. So number one, revenue. So when I look at this business, this sample I call clean CPG company, right? This business, I would say, is quite sizable. It's 1.5 mil. It's over a mil revenue wise, and with a gross margin of about 57%. We know as a CPG business, this is roughly fall into, kind of like into the middle portion of the bell curve in terms of early stage CPG businesses in this revenue range, 1.5 range, have about, close to 60 gross margin. So we would say revenue wise, check. Gross margin, check, right? They all fall within pretty safe ranges. And then the next we check is contribution margin. Contribution margin is basically, it tells how likely this business is breaking even. As we know, break even means you don't keep losing, you don't keep having cash outflow continuously, right? And contribution margin is very related to break even. It basically equals your sales minus your cost of goods sold and minus your direct sales marketing cost. Whatever, if you still have money left, that will be spent on all the back office, I call G&A expense. We only have 7% left. So in this case, I would say this business is likely losing money. As we know, most business, especially in the early stage, their back office cost typically ranges, I would say 20, 30, sometimes even more, anywhere between 20 to even 50% could be their back office G&A expense. So only 7% left to be spent, allocated across all operational costs. It seems like this business is losing money, right? I would say next, let's take a quick look at the key ratios on balance sheet. We see this business in the bank, like all the bank combined together, the bank ending balance is 90K. 90K, compared to 1.5 mil sale, we calculated the cash runway, which can only last for 1 month. So this is red status. typically I would say cash flow should at least last 3 months, like ideally 6 months, but at least 3 months. 1 month is definitely red. Debt to asset ratio seems like green. Inventory analysis is also red. I will leave it to Kiana to dive into more detail about the balance sheet key vitals. So if you think of, hey, you're going to a doctor's office, you did some blood check, this is the initial reading. You got 2 red signals, one yellow signal, basically. So and then now let's get into what can you do in the 30, 90, and 180 days to quickly, I would say, turn around your cash situation. Obviously, this business is having a red siren going on cash because he or she has only 1 month left to spend, right? So the quickest way, I would say, quickest, easiest, may give you instant cash saving from income statement is I will start with 30-day opportunity. 30-day opportunity, the Pocket methodology is look at your G&A. Because as I mentioned, the 30-day opportunity, let's do the stack rack and let's take the low-hanging fruits that's likely quickest to be reduced, at least impacting your top line. And if you ask me to wear my CFO hat, I would say look into your G&A expense. G&A, again, it's after contribution margin, after cost of goods sold, after your sales marketing cost, and most of those expenses lie under G&A. And within G&A, I would say first, let's look at non-labor costs. Anything related to labor, it may affect the morale, may affect the livelihood of some people, always take longer time, right? The easiest way for you to cut to reduce expense without impacting your business in a material way is G&A non-labor cost. So when I look at this business, and I basically dig under G&A, general administrative costs. There are like probably 15, 18 line items or accounts under G&A. So and what I do is, first of all, I basically tag them by labor related. Obviously, payroll is labor related and non-labor related. Obviously, all the other accounts are non-labor related. And within non-labor related, I basically calculate, the weight as percentage of total G&A, and I marked on the biggest spending. It seems like a software, rent, professional services, and other G&A. So 30-day, I would say let's laser focus on all the transaction and transactional counterparties that have software, apps, rent, professional services spending. That's what Pocket software will be able to provide to you actually instantly. So when you sign up with our process, we will give you the 30-day recommendation on specific transaction counterparties that you may want to review and cancel or reduce cost. So the same methodology we're going to apply to 90-day and 180-day. For the purpose of the timing, I'm going to probably just skip most of them. But within 90 days, we typically look at G&A, I would say, labor related, and we start with the order of operation and start with internal stuff and start with internal contractor payout. You may be able to optimize your contractor payout and then go with full-time optimization. And then, look at G&A external partners. External means, hey, your invoice customers, maybe you can optimize for them to pay early. And look at your PO and BOS partner. Maybe you can pay less down payment, you can pay them later, renegotiate terms, right? So those are 90-day opportunities. The other big item under 90-day opportunities is once we optimize the G&A, we can move up to direct expense, meaning most of your marketing sales expense. So on this Excel spreadsheet, we see that, oh, this customer actually also has like about 8 or 9 different direct marketing sales expense. We also did a quick analysis to look at the composition, and we identified a few, I would say, opportunities, such as social media buy, such as the influencers, such as events, that for you to scrub to potentially, concentrate on the biggest bang per buck, for example. So this is called ROI, direct expense optimization. Obviously, 180 days, typically we would do deep dive on your, for example, your cost of goods sold structure, like your inventory supplier optimization, raw material production cost, packaging costs. Those, renegotiate or change supplier may take a longer time, but may result a more optimized gross margin. Obviously, those fall definitely under a longer term horizon. Of course, from P&L perspective, pricing is always something you may have on your mind. I'm not gonna dive deep into those because those definitely were, I would say, a CFO level discussion and planning. With that being said, if no questions, I'm gonna pass it over to Kiana.
Great. Let's chat through the balance sheet. Alice, do you mind zooming to 9? Oh, that's actually perfect to see. So as Alice mentioned, there's going to be some key vitals that we're looking at with the goal of right now bolstering the cash position. As Alice mentioned, the company has about 87,000 in the bank, which is about 1 month of burn. So they're operating at a very thin cash level. Typically, what we'd like to see, I think, in this type of environment is that companies have at least 3 to 6 months to allow for slower periods, to allow for higher expenses. Because 1 month in that situation, it's typically a lot harder to get debt. It's a lot harder to pay your bills and manage cash flow on a go forward. So it's one area that we're gonna specifically focus on. Another one, which you'll hear a lot of the time, is leverage or debt to asset ratio. How much debt are you carrying versus the amount of assets on your balance sheet? When this number is too high, it becomes very difficult to get liquidity in, either in the form of debt capital or equity capital. And the reason for that is any new lender or investor is going to think of their capital infusion as going to repay existing debt versus supplying working capital. So typically, if you see this debt to asset ratio over 2x or into 3x, that's going to be an area where it's going to be very hard to refinance an existing loan. This company, thankfully, is in that green spot where they only have 1x, one debt to one asset, meaning for every $1 of debt they have, so they have 100K in debt, they have 100K in assets. So it's a pretty good, healthy level. The optimal level, I think, is below 0.5x, but that's not very typical for companies that carry inventory. And the last piece, which is the biggest asset typically on any CPG book, is going to be inventory analysis. One of the things, just as Alice did on the P&L, is taking a percentage of the expenses and looking at it as the whole. What I do when I scroll through a balance sheet is I look at the largest asset items and the largest liability items. As you'll see here on inventory, or on the asset side, inventory is going to be the biggest asset item. And then if you scroll down to the liability section, you'll see that there are a number of loans, the largest one being the loan payable Wayfair, that is the largest one. Going back to kind of accounting basics, a large asset means it's a use of cash, meaning you don't have cash because your cash is tied up in that asset. And a large liability is a source of cash, meaning they have provided capital to you to obviously operate your business. So in terms of 30-day opportunities, there's the simplest ways to get cash in the door is to raise money, either in the form of equity or debt, or carry less physical assets to run your business. So I know the funding environment has been very interesting. Equity dollars in this space may be a little tighter, but I do urge some of the companies that I'm working with to continue to have conversations about what are the metrics and milestones or things that need to happen to raise equity, because that is likely the easiest form to get cash on the balance sheet. And then the second being is managing the inventory. So if you see, as of December, the company has around, I'd say 570,000 of inventory on the balance sheet. Back on the P&L, the company's COGS on a monthly basis are around 65 to 70,000, meaning that's the average amount of goods that they're selling through. So if you take 570, divide by 65, you have about 8 to 8.5 months of inventory currently sitting in warehouses that you are not selling through. And that's a big use of cash right now. Sometimes you have to understand more of the company's business model to understand why that's occurring. So if you have a majority of your business through a retail or wholesaler and you're in the process of fulfilling a big PO, this could make sense as to why the inventory is so high. But if a majority of your company is through e-commerce, like this company who is selling through Amazon, this likely means that they're sitting on a lot of inventory that is not selling, or they did a bulk order and they're now waiting to sell through. What I would say for a company that does a majority of their business on e-com is to have no more than 4 to 5 months of inventory on the balance sheet at one point in time, which this company has 8 months, means it's in excess. So what I would do is probably hold off on procuring more inventory to get into that level. Obviously, understanding you need to make sure with lead times and deposits that all makes sense, but having that equation balance a little bit more closer to the 4 to 5 range. The other piece is taking a look at your inventory aging. So understanding how long certain products have been sitting on the shelf, are not selling through, and get a strategy for each of those buckets. Aged inventory, I would categorize anything that's been sitting for more than 6 months. And for SKUs that have really low performance. If you have an abundance of these, there may be opportunities, as Alice had mentioned earlier, to do something like a flash sale. So maybe you're not selling at historically a 50% gross margin, maybe you're selling at 30%, but that's bringing in cash in the door to allow for more flexibility to operate the business and continue selling the SKUs that have a lot of high performance. So those are the key areas that I would focus on for the first 30 days. In the meantime, also looking at what I want to focus on in the next 90 days, you can also have those conversations and start those processes early. A lot of this is going to be vendor term negotiations and managing what you can with free credit versus cost credit. And I give it 2 categories because anytime you work with a supplier who gives you 30 days, 60 days, whatever that time frame to pay is, that's considered free credit. There's usually no cost, and sometimes there's actually a benefit to paying early with discount pricing. But if you can align that free credit with short-term working capital, you can actually extend out your payables a lot longer than if you were paying on day 0. So for example, if you have a vendor that will allow you to pay 45 days later, and right now you're paying on 27 to 30 days, you're actually missing out on 15 days of free float. So what you could do is extend your payables all the way until that time frame that you can pay, and then use a short-term working capital provider to pay off that debt, or to pay off that short-term debt, and then extend it out an even longer 60, 90, 120 days. There are a lot of invoice factoring type companies that will do this, as well as bill pay management solutions that you can leverage for their financing solutions, where you can actually extend your your investments on inventory, your investments on sales and marketing upwards of 180 days. Now, obviously, you don't want to do that in perpetuity because it can create cash mismanagement, but in times where you need to preserve cash, this can be a really good way to retain more of the cash on your balance sheet while still making your payments and being on time with your vendors. I know there's a couple questions that popped up. I'm going to finish through this and we'll answer those in a bit, but thank you for the questions. The other piece, and this has become, I'd say, something that I see a lot in the space is using multiple short-term loans, specifically in the alternative finance and merchant cash advance space. Now, these loans definitely have value in situations in which you're really early and you may not necessarily qualify for larger types of financing, but they can be detrimental when you have multiple repayment cycles that are happening at the same time. I generally say more than 2 types of alternative financing loans stacked on top of each other becomes very, very difficult, even for a CFO or someone in a finance team to manage, just because of the variability. Usually they are taking a percentage of revenue at different times and at different percentages, and it's really squeezing the borrower and what they get paid at the end of the day. So my recommendation is, if you are currently using more than 2 of these, I would look to see if you can pivot the relationship to one provider who could do all of the financing for you, or choose 2 different types of short-term financings that have maybe different repayment structures, so you're not getting double debited as you're selling through product. So for example, this company is using 3 different providers, and it's likely, we know with Shopify Finance, that's typically revenue-based finance, so it's a percentage of your daily revenue. We know with Settle, this is invoice financing, so it's usually a lump sum payment or an amortizing payment every 30 days. And with Wayfair, there's probably some type of variable repayment as well. So from a cash flow perspective, this is going to be really hard to understand how much is getting repaid each day and how much I need to borrow. And I would recommend simplifying the loan structure to something that is more easily projected, and you can know how much each month that you're paying. This kind of dovetails into the 180-day opportunities. And my recommendations for a lot of companies right now is try to find a long-term loan structure that's amortized over a few years. And the reason for this is that there's going to be a lot of uncertainty, as Alice mentioned, with the tariffs, with the economy. We just don't know what that's going to do to the industry. And it may make sense to have a more predictable debt source that, you know, the principal balance is going to maintain, pretty robustly month over month, and maybe you're paying 10 to 20,000 versus 50 to 100,000 on a monthly basis, and recycling that capital. Another thing to call out, and I'm sure all of you know this in your experience with working with alternative finance, but these are non-committed facilities, meaning that at any point in time, if liquidity is tight, performance is low, they have no obligation to continue funding. Versus if you're going to work with a more long-term loan structure, they will approve you at day 1, they'll advance you the money, and then you pay back over time. Obviously, there may be covenants or performance metrics there, but the capital is already out the door and they can no longer withhold that from you. So that's something to consider when you're looking at structures like term loans versus short-term working capital. And then the last piece, which ties pretty closely to what Alice was chatting through on the P&L, is that if you notice on this company's balance sheet, they have a negative equity position, which is generally, for a company at $1.5 million, this is not that big. If they were able to hit profitability and that equity position were to become more positive, this will reduce the leverage or the amount of debt that they would need, because the cash flow would then help sustain the business. And I mean, I think that's the goal with cash management in general, is how do we become more self-sustaining and less reliant? So really, I think to strengthen the balance sheet for more than 180 days, all of the changes that Alice mentioned on the income statement will greatly help align the 180-day strategy on the balance sheet, just by providing more cash flow. Some other items that may or may not be applicable here that I see with some CPG companies is just managing their accounts receivable, especially if you're starting to sell into distributors, wholesale. Sometimes there's not a lot you can do if you're working with big dogs like Target or Costco. But if you are working with smaller retailers and there is a history of late payment or stretching the receivables, there are negotiations that you can have, or maybe you decide you want to exit that relationship because the squeeze is not worth the juice, as a similarity or a saying that I have. So things that you can think about is on the accounts receivable side. And then another call out here is if you have shareholder loans or convertible notes, maybe start having conversations about what it would take to convert those into equity and make those more long-term sources of capital. I know that was a lot, so I'll pause there. I will open up the chat, see what questions we had.
Yeah, it looks like we had one question. When you were talking through the different ratios, especially around inventory, what about wholesale businesses? How many months would be ideal? We were talking about some of the, the DTC and e-commerce kinds of situation. Wondering what about wholesale?
Yeah, this is a great question. And honestly, a question that I think a lot of alternative financiers get hung up on, because when you see that large balance, 8 months, you're like, oh, wow, they're really, they've over ordered. But in the back side, or, the company's perspective, if they have a history of purchase orders from wholesale, we can use that to project forward what the current volume would be. There's always a pretty big risk in the first 6 to 12 months of breaking through into wholesale, because you never know what the expected volume is going to be in terms of purchase orders. So some of the things that I would look at and kind of do a go forward analysis is how often is the retailer requesting product? Is that product consistent? Are they requesting 100 to 150K per month, or each month is it increasing by 25%? If you can build out a history of what that volume and timing looks like over a year and be able to provide that, then I think with pretty good certainty, you should know how much you want to carry, which, I'm not sure what your cash conversion cycle is or how long it takes to procure goods, but in general, to get goods in the warehouse, it would take anywhere from 3 to 4 months. So if you're projecting forward what that volume is going to look like as it continues to grow, generally wholesale businesses are going to look like they're carrying between 9 to 12 months of inventory. But if you provide support via historical purchase orders, obviously a lot of that inventory gets wiped out pretty quickly when it gets delivered to the retailer. So long story short, it's not necessarily a science on the amount of months versus doing a projection analysis with the historical purchase order volume and understanding the duration for which you need to, your lead times to get those products in. I hope that answers your question, Alex. Perfect.
Awesome. I know we're going to open up the floor to for folks to ask more questions. Before we do that, I do want to share I think this is the last slide. Is that if you want us to, i.e. Pocket, to help you personalize your own better cash management journey, which includes recommendations on 30-day opportunities, 90-day, and 100 and beyond, longer term opportunities, you can go to this link, or if you can just do the QR scan, register there in the form, answer a few questions so we understand what's your cash management goal, what's your starting point, and then we will be able to give you a free better cash management journey book.
And the link is in the chat as well. If folks want to click on it, or if you're on your phone, you should be able to scan the QR code and just fill out name and email address and a couple other quick things, and Alice and the team will get back to you.
Right. Thank you, Chris. With that, any additional questions? You can raise your hand, show your face, or you can type the questions in the chat. Sounds like no question, or oh, Chris has one. Go ahead.
Oh, looks like he had to leave.
Chris has to drop. Okay. Well, so how about we do a last call? Any questions, or if you would like to follow up separately offline, welcome to do that as well. I think you know how to reach out to me. I have my email at the beginning of the slide, because many of you are Pocket's customer as well. So feel free to email me Or I would say if you like us to build a personalized cash management journey book for you, sign up here. We'd be happy to do that for free. All right.
Thank you so much.
With that being said, yeah, thank you very much. Hope this is helpful, and reach out to us if you have more questions.
Take care, guys.
Thank
Bye.
you. Bye.